Hello everyone, it's Dan Boodoo from Kensington Accounting. We are an online course provider specializing in accounting. This video is part of a series of revision videos for IGCSE and GCE O-Level in accounting. Today we will be reviewing the IGCSE Accounting June 2020 Paper 1 Series 1. Just a quick note of my profile so that you have an idea who is your tutor. We also offer the following courses as shown on your screen. Please visit our website for more details. So let's go straight to the questions. Paper 1 has 35 questions and we will be reviewing all of them. So please be patient. Question 1 essentially deals with the difference between bookkeeping and accounting. So let's look at the differences. Bookkeeping essentially is about recording of financial transactions, whereas accounting, it is using those financial records prepared by the bookkeeper to do more complicated or sophisticated tasks like preparing financial statements, analyzing financial data, interpreting financial data, and communicating those financial data. Therefore, based on these definitions, let's look at the four possible solutions. A, it says accounting involves measuring. Measuring, yeah, that's preparing financial statements. So that looks okay. B, accounting is a recording. No, so it doesn't record. That's bookkeeping. That's wrong. C, bookkeeping involves communicating. No, communicating is the function of accounting. So that's wrong. D, it says bookkeeping uses ratio analysis. So analysis, no, that's accounting, that's not bookkeeping. Therefore, the correct answer is A. Question 2. Question 2, we need to calculate what is the total liabilities from the list of assets and liabilities as per the table. So let's go item by item. First item is loan from. Okay, that's a liability because it is money owed by the business to XY Finance. Wages due is also a liability as it is wages due by the business to its workers. Rent prepaid, that's a current asset. Trade receivables, that's also a current asset. Trade payables, that's money owed by the business to its credit suppliers and therefore it is a liability. Motor vehicles, it is a non-current asset and therefore it is not a liability. Now regarding provision for depreciation, okay, just to avoid confusion by students, please note that provision for depreciation, despite it being a credit balance, is not a liability. It is in fact part of non-current asset. It is simply a set off against costs of non-current assets to obtain its net book value. Therefore, provision for depreciation is not a liability. Therefore, total liabilities is 10,000 plus 620 plus 4650, which is 15,270. Therefore, the answer is C. Question 3. So again, let's look what the question requires. It says, what entry would Nina make of the transactions of 12th of April? So we're looking from the point of view of Nina in the ledger of Nina or the books of Nina. Okay, so it says Nina received a check from Zafar, who is a credit customer, and on 12th of April the check was returned and paid. Therefore, it is a dishonored check. Now, the double entry for returned and paid check or dishonored check from credit customers it is the opposite. Okay, it is the opposite of the double entry for a receipt. Okay, now when you receive money from a customer, you would debit your bank and credit the customer's account. And for a returned or dishonored check, you will do the opposite, which is you will credit bank and you will debit the customer's account. Therefore, looking at the possible answers, the answer should be D, as it credit bank and debits the customer's account. Question 4. Okay, it says in the books of Anne, Cindy's account is a credit balance of 520. By that, we mean that the credit balance indicates it is a liability, therefore Anne owes money to Cindy. Okay, Anne owes money to Cindy. Now let's look at the two transactions. On April the 2nd, Anne returns goods $30 to Cindy. Okay, so it's a return of goods. Therefore, this will reduce the liability of Anne by $30. Therefore, the liability goes down by 30. It becomes $490. On April the 14th, there was purchase of goods, but the purchase was paid in cash. Therefore, it is cash purchases. The cash purchases wouldn't be entered in the account of Cindy in the books of Anne. Therefore, it doesn't affect the remaining liability. It does not affect. Okay, because it is a cash purchase. Therefore, at the end of the month, Anne owes Cindy $490. Okay, so Anne owes Cindy $490. Therefore, the answer is A. Okay, that's question 5. Let's read the question carefully. It says goods bought on credit by Tumelo. Therefore, Tumelo is a customer. Okay, and Tumelo has returned goods to Tebogo. Okay, and the question is, where would Tumelo record the returns of goods? So Tumelo is a customer. It has bought. When it buys, it is a purchases, and when it returns, it is a purchase returns. Now, how do we record a purchase return? What are the double entries for a purchase return? Okay, a purchase return, the double entry is the opposite of a purchases, and therefore the double entry for a purchase return is we credit purchase return and we debit the supplier account because it was obviously bought on credit. Now the purchase return, it is found in the general ledger, and the supplier's account is found in the purchase ledger. Therefore, the double entry affects both the purchase ledger account and the general ledger. Looking at the answers, answer A, it talks about cash book and sales ledger. Obviously, that's wrong. None of them are correct. Answer B says general ledger only. That's wrong because it also affects the purchase ledger. So that's wrong. Answer C seems okay. D, it talks about purchase ledger only. That's also wrong because it also affects the general ledger. Therefore, the correct answer is C. Question 6. So the requirement of this question is what is the closing balance? Okay, closing balance at the end of the month. Essentially, it says Dave is a supplier to Peter and Peter buys on credit. At the beginning of the month, Peter owed some money to Dave. Okay, during the month, Dave sent and received the following during the month. Now, there are 4 items here. Let's look at each item, okay, one by one, and let's see what is the effect of each item on the balance owed by Peter to Dave. Okay, first item is an invoice. Okay, now invoice means it represents rather goods sold to Peter. Okay, therefore the effect of an invoice is that it will increase the amount owed by Peter to Dave. Therefore we have 440 in the beginning. Okay, this 360 would increase the amount owed, so it's an addition. Second item is a check payment of 429, but also it states there was a cash discount of 11. Therefore, when you have a cash discount, the reduction of debt is both inclusive of the check payment plus the cash discount. Therefore, the reduction of the debt is minus 440 because it needs to also include the cash discount. Now, debit note, that's a trick. It's very important that students really understand what a debit note is. Now, I've written here, a debit note is only a request. Okay, it's made by the customer for a reduction in the amount owed. Okay, but it is only a request. It's not an invoice, not a credit note, and therefore it is not accounted either by the supplier or the customer, and therefore must be ignored. Okay, therefore this 50 should be ignored because it does not affect the balance owed by the customer to its supplier. Lastly, we have the credit note. Now the credit note, in fact, it is related to the debit note. It means when the credit note is issued by the supplier, it means the supplier has accepted the request of the debit note and it has issued a credit note. And the credit note will therefore reduce the amount owed by Peter to Dave. So at the end of the month, when we add all the four, we get 310, and therefore the amount owed by Peter to Dave at the end of the month is B. Question 7. What is recorded in the sales journal? That's very straightforward. Okay, a sales journal records only credit sales. So it's very important. It doesn't include cash sales, for example, and also it records only goods for resale and therefore would not include items like sale of non-current assets or other types of receipt. Okay, now let's look at the four possible answers. A, it talks about money, therefore that's wrong. Answer B talks about all sales. Now all sales would include cash sales and therefore that's wrong, obviously. Answer C, it talks about cash sales. That's wrong because sales journal records only credit sales. Answer B looks fine. Therefore the answer is D. Question 8. Okay, which statement about a 2-column cash book is correct? Now, the students must understand that a cash book and a petty cash book they are both books of prime entry, and they're also ledger accounts in the general ledger. Okay, the only difference between a 2-column cash book and a 3-column cash book is that a 3-column cash book also includes cash discounts. So on the debit side, a 3-column cash book will have a discount allowed column, and on the credit side, a 3-column cash book would have a discount received column. However, in a 2-column cash book, there's no discount allowed column or discount received column. There's only 2 columns on the debit side and on the credit side, one for bank and the other one for cash. Okay. Now let's look at the 4 possible answers. Answer A, it says a 2-column cash book. It is a ledger account for bank transactions only. That's wrong because the 2-column cash book also includes a column for cash. So that's wrong. B, it says it is a ledger account for cash transactions only. That's also wrong because the 2-column cash book also includes a column for bank transaction. C, it is a book of prime entry. That's correct. A cash book, same as a petty cash book, is a book of prime entry as well. D, it says it records cash discount. That's wrong, because a 2-column cash book doesn't record cash discounts. It is only the 3-column cash book which records cash discounts as well. Therefore, the correct answer is C. Question 9 deals with trade discount. Okay, let's look at the definitions, the purpose, and of any accounting entries, if any. Okay, a trade discount definition, it is simply a reduction on the listed price, and it is shown on the invoice. Purposes, it is given for bulk buying, it is given to loyal customers, and also to other traders in the same trade or business, just like a wholesaler would give a trade discount to smaller retail customers. Now, in terms of accounting entries for trade discount, there is no accounting entry for trade discount. Okay, trade discount is not recorded, is not posted in any of the ledger accounts, both by the supplier and the customer. None of them make any accounting entry for a trade discount. However, the supplier or the customer can make a note of a trade discount in their respective sales or purchases journal, but no accounting entry is made of a trade discount in any of the ledgers. Now let's look at the possible solutions. Item number 1, it talks about debited to the supplier's account. That's wrong. No entry is made in any ledger account whatsoever. Number 2, the invoice, if the invoice is paid within the period allowed by the supplier, here it is referring to a cash discount, not a trade discount. Therefore, that's wrong. Number 3, it is shown as a deduction from the price of the goods on an invoice. Yeah, it is a deduction in fact from the listed price, and it is shown on the invoice. Therefore, this is the correct answer. And lastly, it is used to encourage bulk buying, as we saw earlier. That's one of the purpose of a trade discount. Therefore, this is a correct answer. Therefore, only items 3 and 4 are correct. Therefore, the answer is D. Okay, this question is about what are the reasons, what are the importance, what are the uses of a trial balance. Basically, it has 3 purposes. Okay, the purpose of trial balance, it's got 3 purposes. First, to check arithmetical accuracy. It also is used to prepare financial statements and also assist in the location of errors. Now, let's look at the 4 possible solutions. Analyze financial information, no. To assist preparation of FS, yes. Control cost, no. Evaluate performance, no. Therefore, the correct answer is B. Question 11. So a business has a loss of 16,000, and subsequently it has discovered 2 errors. We need to make correction of the errors to find the corrected loss. Now, item number 1, no adjustment has been made for insurance prepaid. Now, insurance prepaid is just a yen adjustment. The double entries for a prepayment of expense is debit other receivable and credit the expense account. In this case, insurance, the amount is 480. When you credit insurance account, the insurance expense amount will reduce by 480, and this will reduce the loss by 480. Item number 2, no entry has been made for bank charges. Therefore, the correction would be to debit bank charges and credit bank 620. When you debit bank charges, this will increase the bank charges expense, and therefore this will increase the loss. Therefore, the corrected loss is, we start with 16,000. The first item reduces the loss, therefore it is minus 480. The second item increases the loss, therefore you add by 620, and the final corrected amount is 16,140. Therefore, the answer is C. Question 12 deals with a bank statement. Okay, and it says at the beginning of the month, 1st of April, the bank statement shows a debit balance. Now, a debit balance is obviously a bank overdraft. Now, there are 4 movements during the month. Let's look what is the effect of each of these 4 movements in the bank statements, and what happens to the closing bank balance as per the requirement of the question. First item, it is a check deposit. Now, a check deposit, it will it's a positive to the business, and it will increase the bank balance. Therefore, if we start with minus 600, this 7,400 will be an addition to the bank balance. Second item is a check payment. A check payment is an outflow, therefore it will reduce the bank balance. Third item, direct debit, is a payment. Okay, a payment, it will reduce the bank balance. Lastly, the credit transfer from a customer is equivalent to a deposit, therefore this will increase the bank balance. If we add the closing balance will be positive 870. Okay, a positive bank balance is a credit balance in the bank statement. Therefore, the correct answer is A. Question 13 is an error made in the sales ledger control account. Okay, now the correct entry for a contra entry on the control accounts is debit purchase ledger control account and credit sales ledger control account. Now, in the question it says the contra entry was entered on the wrong side of the sales ledger control account. Therefore, instead of crediting, it was debited. Therefore, to correct that entry, we need to first correct the initial error, and to correct the initial error, we need to credit the sales ledger control account to net off the initial error of debit entry, and to get the right balance, we need to further credit the sales ledger control account. Therefore, in total, we'll have 4,000 of a credit entry. Therefore, the correct balance would be 10,000 minus 4,000 to get the final balance of 6,000 debit. Therefore, the answer is A. Question 14 is about capital expenditure. Now, capital expenditure relates to purchases or additions to non-current asset. Okay, now we have the various definitions. It relates to, as written here, purchase of non-current assets, purchase, okay, which includes a carriage or transportation costs for the delivery of a non-current asset. It will also include decorations to a newly, okay, not an old, but to a newly acquired non-current asset. It will include installation costs. It will include legal costs. Okay. However, repairs, painting, decorations which are done at a later stage, for a old building, are considered as normal repairs and maintenance, and therefore is treated as a revenue expenditure, and it is expensed. Okay, therefore, here we have a summary. Decoration costs for a new building, that's a capex, capital expenditure. Decoration cost to an existing building, that's a revenue expenditure. Okay. Delivery charges regarding the purchase of a non-current asset, that's also a capital expenditure. Aircon, whether it's new or old, aircon is an equipment, therefore it's a non-current asset. It is a capital expenditure. Legal fees for the acquisition or purchase of a building, that's also a capital expenditure. Things like name plate cost of a new motor vehicle, that's also capital expenditure, is part of the motor vehicle. Wages of employees installing, so that's installation cost of a new machine, that's also capital expenditure. So these are the definitions. Now going back to the questions, building costs, obviously that's a capital expenditure. Legal fees relating to that's also a capital expenditure. Aircon, whether to the new building or original building, they are both equipment, they are both capital expenditure. Decoration costs, if it is to a new building, it is capital expenditure. However, if it relates to an old or original building, like in this case, it is considered a revenue expenditure and an expense, is part of the repairs and maintenance expense account, and it is not a capital expenditure. Therefore, the question is, what was the total capital expenditure? It will be 65 plus 1800 plus 2300 plus 1100 plus 800, that's 71,000. Therefore, the answer is C. Question 15 deals with depreciation. So initially, the asset was depreciated using a straight line method, which was incorrect. The correct method should have been the reducing balance method. Therefore, what we need to do, we need to calculate the depreciation for each method and then make the correction. Now, using the straight line method, what is the depreciation? It is cost minus residual value divided by the useful working life. So it's 20,000 minus, which is the cost, minus the residual value divided by the useful life or working life. We get 4,000. Now, the depreciation using reducing balance method is the percentage times the cost. So it's 30% times cost, which is 6,000. Now the trick here is to trick the student into taking into account residual value while calculating depreciation using the reducing balance method. So there's a note here. Essentially what we're saying is, when we use the reducing balance method, the residual value is ignored because the percentage of 30% has already taken into account the residual value. Therefore, if you include 4,000 in the reducing balance method, you'll be double counting it. Therefore, using the straight line method should have been 4,000. And using the reducing balance method, the depreciation is 6,000. Therefore, what was the effect on the profit for the year of correcting this error? Therefore, when you correct the error, the depreciation will increase by 2,000. When the depreciation increases by the 2,000, the profit will go down by 2,000. Therefore, the answer is A. Question 16 is about a prepayment of rent. Okay, so what it says, a company's year end is 31st December. On 1st of December, it paid rent of 8,000 for the 4 months. Okay, 4 months. Okay, ending 31st March 2020. Therefore, the rent paid was for the months of December, then January, February, March. Okay, now it paid 8,000 for 4 months. For 4 months, therefore, the monthly rent is 8 divided by 4, 8,000 divided by 4, which is 2,000. Now the prepayment is what? The prepayment is for the 3 months, January to March 2020. Therefore, the prepayment is 2,000 times the 3 months, which is 6,000. Now, what is a prepayment? The opening balance. A prepayment is we're talking a prepayment of an expense it is a current asset, it is other receivable, therefore it is a debit balance. So the amount is 6,000 and it is a current asset, therefore it's a debit balance. Therefore the answer is D. Okay, this question deals with other income. Okay, and we are talking about prepayments and outstanding income at the end of the year or the beginning of a particular year. Now, both commission receivable and rent receivable, we're talking about income. Okay, and income outstanding or accrued income means the customer owes money to the business. Okay, and is therefore a current asset. In this case, commission receivable with a debit balance, it means income outstanding, that is money owed by the customer to the business. Income prepaid means when a customer has overpaid or paid a deposit. Okay, this money is owed by the business. Okay, the business owes the money to the customer. It is a liability and a credit balance. Therefore, rent receivable with a credit balance, it is equivalent to income prepaid. So here we're talking income outstanding, and here for the rent we're talking income prepaid. Therefore, the correct answer is B. Question 18 deals with the accounting entries for provision for doubtful debts. So just let's have a quick recap of the accounting entries. So when the business is creating for the first time a provision for doubtful debts, the entry is debit income statement, okay, and credit the provision for doubtful debts by the total amount being created, okay, by the total amount, because it is the first year. For subsequent years, in the event of an increase in the provision for doubtful debts, the accounting entries is same as the creation. Therefore, we debit income statement and credit provision for doubtful debts. But in this case, it is only by the increase, not the full amount, only of the change or the increase. In the third scenario, where there's a decrease in provision for doubtful debts, the entry is reverse to an increase. Therefore, instead of debiting income statement, we credit income statement, okay, and we debit the provision for doubtful debts account by the decrease, okay, not by the full amount, by the decrease. So here it is a full amount, here is the increased, okay, and when the decrease is by the decrease amount. Now, just to remind the students, provision for doubtful debts is never entered in the customers or the sales ledger control account. Okay, only irrecoverable debts written off or recovery of bad debts written off, which are entered in the customer's account or the sales ledger control account. Now, coming back to our question. Okay, we are talking about an increase by. So by is the amount of increase. So therefore, it's number 2 here. Therefore, we debit income statement and credit the provision for doubtful debt accounts by the increase. Therefore, the answer should be C. Question 19. Which items are deducted from gross profit when calculating profit for the year? Now, obviously, it is referring to expenses, because expenses are deducted from gross profit to calculate profit for the year. Now, let's look at all the 4 items to see which one are expenses. Item 1, it is a balance on the provision for doubtful debts. So it is referring to balance here. Okay, balance, right? Not the increase. if it was an increase in the provision for doubtful debt, yeah, that would be considered as an expense, and it will be deduction from the gross profit, not the balance itself. The balance on the provision for doubtful debts is an item which goes in the balance sheet. Okay, it is part of the current asset. It is a set off against trade receivables. Therefore, item 1 is not an expense. Item number 2, carriage paid on goods supplied to customers. That's we call it carriage on sales or carriage outwards. This is an expense. It goes as an expense in the income statement. Item 3, drawings. No, drawings is not an expense. It goes straight in the capital account in the balance sheet. Therefore, it is not an expense. Wages paid to employees. Yes, wages is an expense. Therefore, this is correct. Therefore, only item 2 and 4 are expenses. Therefore, the answer should be D. Question 20 deals with the effect of a particular transaction on the balance sheet. So in this case, goods costing 140 were sold for 220. So let's see the impact of this transaction on the balance sheet. Okay, so the first effect is the inventory on the balance sheet. Okay, will go down by 140 because inventory is recorded at cost. So that's the first effect. The second effect is because it is sold on credit. Yeah, therefore the trade receivables will go up by 220. In other words, the current assets go up by 80. Okay. Now, because the business has made a profit, the cost of the goods was 140 and the sale was 220, the gross profit and the profit will go by 80. Therefore, the profit will increase by 80. So this is the effects. The current assets go up by 80 and the profit goes up by 80. So looking at the possibilities here, so we're looking at 80, 80, 80. So if the current asset goes up by 80, obviously the net assets will also increase. And the capital, the profit obviously is part of capital. Increase in profit also means an increase in capital. Therefore, the answer is B. Question 21. We are dealing with an adjustment for rent owed by a tenant. So that's a rent owed by a tenant. Therefore, we are referring to rental income, not an expense. Now, if a tenant owes money to the business needs to make an adjustment so that the income statement reflects rental income for the whole year, not just the amount received. And the double entry for outstanding or accrued income is debit other receivables, because this is money owed by the tenant to the business. And we need to increase rental income because there's accrued income. Not all of the rental income was paid to the business. Therefore, we need to increase the rental income or rent receivable account. Therefore, the double entry is increase in rental income will increase profit. Okay. And debiting other receivables will increase current asset. Therefore, the answer is D. Question 22 deals with an omission of drawings of goods. Let's see what is the normal entry for drawings of goods. Drawings of goods, the correct entry would have been debit drawings and credit purchases. Now, because this entry was not made, the effect of this error will be that purchases will be overstated and drawings will be understated, because drawings is a debit balance when you haven't included that particular debit entry. The balance will be understated. So this is the effect of this omission. Now, when you overstate purchases, cost of sales also will be overstated, and because cost of sales is overstated, gross profit will be understated, and because gross profit is understated, profit for the year will be understated. Okay, drawings has no impact on profit because it is a balance sheet item. Okay, drawings is not entered in the income statement. Therefore, for the profit of the year, drawings has no impact, and overstatement of purchases it will lower, it will understate profit. Therefore, it's going to be either C and D. Now let's see the impact of the lower profit and the understated drawings on capital employed. Now, when we look at the capital account, okay, in the balance sheet, okay, capital account in the balance sheet or statement of financial position, okay, you have an opening balance, okay, then you add capital introduced, okay, you add profit for the year, okay. Then you deduct. Drawings is a deduction, isn't it? It is a deduction. Then you get your closing balance in the capital account. Okay. Now, because profit for the year was understated and profit for the year is an addition, the impact of this is that capital employed will also be understated. Okay. As per the calculation of a closing balance. Okay. Now, when drawings is understated, okay, now drawings is a deduction in the capital account. When drawings will be understated, okay, the impact is that the closing balance will be overstated. So, an understatement in drawings will overstate capital employed. So the first item understates capital employed, and the second item overstates capital employed. Therefore, the net effect is nil. Okay, so the net effect of this omission on capital employed is no effect. Therefore, the answer is C. Question 23 deals with partnership between Rajit and Sunil. We note that Rajit has a higher capital account. It also has a higher drawings per year, but their share of work is same, 50-50. Okay, they want to draw up a new partnership agreement for future years, and we've been asked which of the following items, if they do include in the agreement, will be most beneficial to Rajit. So let's see. First item, item A, interest on capital. Now, because Rajit has a higher capital account, obviously an interest on capital will be beneficial to him, as he will get twice as much interest on capital compared to his partner Sunil. Therefore, this will be beneficial to him. Yeah. Okay, so we'll tick here. Item 2, that's interest on drawings. Now, interest on drawings is the opposite of interest on capital. Therefore, it is a kind of expense to the partner. It's a deduction in their total share of the profits. Therefore, if you have a higher drawings, it is detrimental to you. Now, in our particular example, Rajit has a higher amount of drawings than Sunil. Therefore, the interest on drawings would not be beneficial to him. In fact, it will be to his detriment. Therefore, including interest on drawings on an agreement would not help Rajid. Item 3, putting a limit on annual drawings. Now, because Rajid has a higher capital, he will get a higher interest on capital. Now, putting a limit on drawings can limit the amount of drawings he can take from the business. Also, that he might be getting a higher share of the profits. Therefore, a limit would not be beneficial to Rajid. Therefore, we put a cross here. Lastly, partnership salaries. Now, because both their share of work is 50-50, we assume that the salaries will be equal. Therefore, including a partner's salary of equal amount would not benefit in particular to Rajid, as Sunil will also get the same amount. So it makes no difference really to him. Therefore, the only item which will benefit to Rajid most will be item 1, that is interest on capital. Therefore, the answer should be A. Question 24 is partnership again, deals with a partnership appropriation account. It's a very straightforward question. So the opening credit balance, okay, of Harry's account is a credit balance. Yeah? It's a credit balance of 28,200. We've been asked what it is closing balance. Okay, so straightforward. Salary is credited, okay, to a partner's account. Therefore, it will add to the opening balance. You need to add the 8,000. Drawings is a deduction because it is debited to a partner's account. Therefore, it's going to be debited. And the share of profit is just like a salary is credited to the partner's account and therefore added. Okay, therefore, its closing balance is going to be a credit balance. Okay, of 38,000. Therefore, the answer is B. Okay, these questions deal with a company. So we're talking about which of these items appear both in the income statement and the statement of changes in equity. It says and. Yeah, it's very important. The question itself highlights the word and. Okay, therefore, you just need to be extra careful. Now, let's look at item A. Interest on debentures accrued. Now, interest on debentures, it is a loan interest. This is an expense. Okay, it is an expense. Okay, and has nothing to do, and okay, is not part of the statement of changes in equity. Okay, therefore, you can cross this out. Dividend paid. Okay, dividend paid is not part of the income statement. Not income statement entry. Okay, we can cross it out. Profit for the year, definitely. Profit for the year appears both in the income statement, of course, and it is also a part of the statement of changes in equity. Therefore, this is yes. Transfer to general reserve, just like ordinary share paid, it is not an income statement entry. Okay, not. Therefore, we can cross this out. Therefore, the answer should be C. Question 26 deals with movement in the capital account of a sole trader. Now, this could be a tricky question, but if you just follow carefully the way I will explain, it will be an easy question to answer. Now, the closing capital, okay, the closing capital is opening capital plus capital introduced plus profit for the year less drawings. Therefore, we say CC, which is closing capital, is equal to opening capital plus capital introduced plus profit minus drawings. Now, a decrease in capital of 200 means the closing capital minus opening capital is minus 200, minus, yeah. Profit we know is given, it says it is 7,000. Therefore, it's just a formula which we need to resolve. CC minus OC minus P, if we send OC and minus P here, okay, it will be minus 200, because CC minus OC is minus 200, P is 7,000. So minus 200 minus 7,000 is equal to minus 7,200 is equal to capital introduced minus drawing. Therefore, capital introduced minus drawings is minus 7,200. If you look at A, B, C, and D, only item A gives the addition, or when we subtract it, minus 7,200. Therefore, the answer is A. Question 27 deals with a sales ledger control account. Now we have an opening balance, we have movements during the year, and the question is how much had trade receivables increased. Okay, so we're talking about increase as highlighted in the question itself in bold. Therefore, the opening balance is irrelevant because we're talking about how much it has increased. Now, this is just a template, of a sales ledger control account for your information. Also not quite relevant for this question, but it's just for your information. Okay. Now, the first thing which we know, a cash sale is not entered in a sales ledger or sales ledger control account. A cash sale, the double entry would be debit cash and credit sales account. It's got nothing to do with trade receivables or sales ledger or sales ledger control account. Therefore, this cash sale is irrelevant. Okay. Now, a credit sales would increase the trade receivables, isn't it? So, 85,000 is a plus because it's a credit sales. The entry would be a credit sales account and debit sales ledger control account. Therefore, it will increase the amount owed by the trade receivables. Cash sales obviously is ignored. Checks received when trade receivables pay money to the business, it will reduce the amount they owe to the business. Therefore, the 65,000 is a deduction, is it not? Okay, is a deduction. And irrecoverable debts. So the company has decided to write off a part of the debt because some of the trade receivables could not or have disappeared and they won't be able to pay. Therefore, this reduces the amount owed by trade receivables. Therefore, the net effect of the movements, of the three movements, is positive 18,000. Therefore, the answer is A. Question 28, so essentially deals with the trading section of the income statement and ratio, because it talks of a market. Now, looking very quickly at this question, so we have revenue, we have opening inventory, closing inventory, markup, and goods drawn or taken for his own use. Now, if we have markup and revenue, we can calculate the gross profit and cost of sales. Now, if we can calculate cost of sales, we have opening inventory, closing inventory, and we have drawings of goods. Therefore, as a purchases, we can find it as a closing balance. Now, let's look at the answer. Just in a quick revision, if markup is x divided by y as a fraction, then gross margin is x divided by x plus y. Or if we have gross margin which is x divided by z, then markup is x divided by z minus x. So this is just a revision, okay? And normally, not normally, the markup is always a higher percentage or fraction than the gross margin. So if you have made a mistake, you can check through this method. Okay. So above the markup is 50%, which is half. Therefore, gross margin. So this is x divided by y. X is 1, y is 2. Therefore, gross margin is x divided by x plus y. X is 1, x plus y is 3. Therefore, gross margin is 1/3. Okay. Now, gross margin, the definition of gross margin is gross profit divided by revenue. Revenue is given, gross margin is 1/3. Therefore, gross profit is revenue times gross margin. So it's 90,000 times 1/3, which is 30,000. Therefore, we know gross profit is 30,000. We know revenue, we know gross profit. Cost of sales will be the difference. 90 minus 30,000. Therefore, it is 60,000. Now, the trading section of the income statement is as follows. Opening inventory plus purchases minus purchases return minus goods for own use plus carried inwards minus closing inventory is equal to cost of sales. Now, in our question, we don't have purchase return and carried inwards. I'll just put this for your general information for any similar questions. Okay. So in this case, cost of sales is opening in inventory 8,000. Purchase, we don't know, we need to find purchase. Purchase return is 0. Drawings we have been given, it's drawings of goods is 7,000. Then what carriage inwards is 0, and closing inventory is minus. Okay, it's a deduction, it is minus 2,000. When we resolve this question, cost of sales we know is 60,000. Therefore, we just resolve this equation and we find that purchase is 61,000. Therefore, the answer is D. Question 29, it is just a ratio. Okay, so we've been asked to calculate a trade payables turnover. Now, the formula for trade payables turnover is equal to trade payables divided by credit purchases net of returns. Net of returns, we mean that if there are purchase return, then the credited purchases should be a net of those purchases return. That is credit purchases minus purchases returns. In this case, we don't have purchase returns, so we can ignore it. So this is a general formula, and we have to multiply by 365, which is the number of days on average in a year. Now, we're talking about credit purchases, therefore cash purchases should be ignored. Therefore, this 125 is not relevant to us. Trade payables is 9,765. Credit purchases, we don't have any purchase return, therefore credit purchases is our denominator multiplied by 365, and the answer is 31 days. So the answer is D. Question 30 is about ratios. So on 1st of January 2019, current ratio, which is the definition of current ratio, is obviously current assets divided by current liabilities, is 2 to 1, therefore 2 divided by 1. Current liabilities is current asset divided by 2. So current assets is 16,000, therefore current liabilities is 8,000. On 31st December 2019, current liabilities increased by 50%, therefore the new current liabilities is 8,000 times 150%, that's 12,000. Current asset divided by current liabilities at the end of the year is 1.5, therefore current assets will be 1.5 times current liability, which is 1.5 times 12,000, which is 18,000, therefore the answer is B. Question 31 is a question about ratios. It deals with liquid or acid test ratio. Okay, we note that year 1, year 2, year 3, between the 3 years, the liquid ratio is increasing from 1.2 to 1.4 and finally to 1.6 in year 3. So that's the first thing which we note. Okay, and the question is explain the changes. In other words, explain why the liquid ratio is increasing year by year. So first, let's look at the definition of a liquid ratio. Liquid ratio is liquid assets divided by current liability. Liquid assets is trade receivables plus other receivables plus bank plus cash, but it excludes inventories. Current liabilities, the definition is standard. It includes trade payables plus other payables plus a short-term loan plus bank overdraft. Now, if the liquid ratio is increasing, it could be due to three reasons. Either the liquid asset is increasing, or the current liability is decreasing, or both the liquid assets is increasing and the current liability is decreasing. So let's go item by item. Item A says inventory is increasing. Now, inventory is not part of this ratio, therefore it is irrelevant. Okay, therefore we can cross it out. It is irrelevant to liquid ratio. Item B, other payables is decreasing. Now, if other payables decreases, it will decrease the current liability and it will increase the liquid ratio. Therefore, this is a possible answer. Item C, trade payables increasing. Now, if trade payables increases, it will increase current liability, and if current liability increase, it will decrease the liquid ratio. Therefore, this is not a correct answer. Trade receivables are decreasing. If trade receivables decrease, this will decrease liquid assets, and it will decrease the liquid ratio. Therefore, this is also not a good answer. Therefore, the only good answer is item B, which is here. Okay, question 32 deals with uses of accounting statements, and essentially which of these four users would be interested in the past performance. Okay, past performance and is important, would be interested into taking remedial actions where necessary. Now, for a government, a government is only interested in taxes. Okay, so a government won't be really interested in taking remedial action. They might be interested on the profitability of the business, to collect taxes and to know how much tax the business should pay, but certainly taking remedial action is none of the business. Therefore, this is a wrong answer. Okay. Second, investors. We're not talking about owners. We're talking about future investors. Future investors at any point in time, they look at many companies where they would be interested to invest, and obviously they look at the profitability of the company to see the trend of profits. Obviously, where business is making good profits, and where it has potential to make even higher profits in coming years, that would be of interest. But taking remedial action is none of the business, and certainly they won't be interested into that. Therefore, this answer is also wrong. I'll come back to managers in a minute. For suppliers, so we're looking at D here. Yes, the suppliers would be interested in the performance of the business, particularly if they have supplied goods on credit to a business, and substantial sums are owed by the business to them. They would be interested in the profitability of the business, but it's none of the business taking remedial actions, as they have their own business to worry about. So supplies is also not a user which would be interested into taking remedial action. Manager, yes, the manager would be certainly interested in the profitability or the performance of the business, because very often managers get paid bonuses or a part of the compensation, pay packet or pay package is linked to profitability. Therefore, yes, they will be certainly interested on the performance of the business. And in case the business is not going in the right direction, they'll be very much interested, both because that's their responsibility, and also to save their own jobs and that of their colleagues. So yeah, so manager is a user of information which would be interested both in the past performance and and taking remedial action. Over and above managers, owners are also another user of accounting statements, just like a manager would be interested in past performance and taking remedial action. Also, in this question, owners is not part of the users which we have been required to answer on this. There's some more notes just to give some more color to the answers for this question. Question 33 deals with accounting principle. So the business year end is 31st December. He pays rent on 1st of Feb, May, August, and 1st of November. So he pays rent quarterly basis. So obviously in November, his payment would have included the months of November, December, and January of next year. In other words, he has paid 1 month's rent in advance for the month of January. Now, rent prepayment or expense prepayment needs to be adjusted, and the accounting principles which requires adjustment is obviously the matching principle, also known as the accruals principles, which requires that all income or revenue should be matched with cost, expenses or losses for the same period, so that there's a meaningful comparison between years, irrespective when the actual payment was made. Therefore, the answer is matching concept B. Question 34, that's another question about accounting principles. We are talking about going concern principles. So we have 4 items. Let's look at each of them. Item A is talking about consistently, okay, applying accounting methods consistently. Obviously, that's a consistency principle, not going concern. Item B, that the business will continue to operate for the foreseeable future. Yeah, that's a going concern. Okay. Before the item A it's not a going concern principle. Item C, revenue is earned when legal titles to goods passes from the seller to the buyer. That is the realization principle and not the going concern principle. Lastly, the business is treated as being completely separate from the owner. That's the business entity principle and not the going concern. Therefore, our answer is B. Question 35, again, it's about accounting principles. So Brad purchased a machine for 1,000 on 1st of Jan. The machine is supposed to last for 4 years. So at the end of the year, we have information that the replacement cost, okay, of that machine is 1,200 to purchase. And the question is, at which value should the machine be included in the statement of financial position, also known as a balance sheet, at the end of the year? Now, there are 3 principles here. Okay, the first principle is historic cost principle. Historic cost principles require that all assets are recorded as a historical or actual cost initially. Okay, therefore this current cost, which is a replacement cost, is wrong. Therefore, answer A and B is no good. Now, both the prudence principle and the matching principles require that non-current assets be depreciated. The prudence principles requires that a non-current asset, if it has lost in value, then that loss in value should reflect in its value shown in the balance sheet. A machine obviously loses its value, therefore it is correct that the value shown in the balance sheet is less than the original cost. Matching concept also requires that if a machine has contributed in generating income and revenue, then part of the cost of that machine should be charged to the income statement to match against the revenue, otherwise the revenue and profit will be overstated. So both the prudence principle and the matching principle requires depreciation. Okay, requires depreciation to be charged every year. Therefore, this no depreciation thing, as in answer C, is wrong. What is required is that the machine is shown at its original cost, and the accumulated depreciation, okay, in this case it's only 1 year because the machine was bought only a year ago, should be charged against the cost, so that the net book value is the original cost less 1 year's depreciation. Therefore, the correct answer is D. Dear students, I sincerely hope that you enjoyed this video. I certainly did, and that it will help you in your revision. If you did like the video, please give it a thumbs up, and please subscribe to my channel. For your information, I'll be posting some more videos in the days to come. See you soon, and good luck in your exam. Cheers.